Good morning and welcome to our Think Big series brought to you by PSG. I'm Etienne Deval, CEO of PSG Wealth. PSG is a leading financial services group founded in 1998 with representation in South Africa and Namibia. We're a proudly advice-led firm backed by some of the leading financial advisors in the country. We pride ourselves in taking a big picture approach to solving our clients' financial needs, be those needs asset management, wealth management, or short-term insurance. The Think Big series is a series of dialogues hosted by award-winning financial journalist Bruce Whitfield, featuring some high-value speakers covering topics that are of obvious concern in the current South African environment. The intention with these discussions is to give our audience some factual insights around the topic and allow them to draw their own conclusions around the matter. The events are obviously free and open for everyone to join, and you're welcome to follow our social media campaign using the hashtag ThinkBigPSG. Our guest today is Dr. Leila Fourie, the CEO of the Johannesburg Stock Exchange. Dr. Fourie has got more than 25 years worth of international financial services experience and also holds a PhD in financial and economic sciences. So today's discussion will definitely be interesting around the financial markets. Thank you, Bruce. Over to you.
Etienne, thank you very much indeed. Leila Fourie is with us, as Etienne says, and what a year 2020 has been, Leila Fourie. I mean, an extraordinary year. You would have had plans because you arrived at the JSE not much more than a year ago. You'd been in Australia for a while. And then you would have done your planning and you would have met the team and you would have structured everything and you would have been very careful about 2020, make a good first impression in 2020. At what point did you take those plans and just tear them up and throw them all away?
Yeah, Bruce, actually, funny enough, I did land into a relatively benign environment, notwithstanding the fact that we were kind of leading into this potential downgrade. And in fact, I was climbing mountains in Cape Town with friends from Australia at the beginning of March, just before the looming lockdown started rearing its head. And so I was caught quite by surprise watching what was happening in China. We began as an exchange to start rotating a work from home environment prior to the lockdown. And there's no playbook and no lessons learned from any of my predecessors in managing and navigating through a crisis of this magnitude. So but that said, I probably wouldn't have moved across if it weren't for an exciting and adventurous opportunity.
Exciting and adventurous it was going to be. Not exciting, adventurous, and completely unwritten. So you're sitting you're on the mountains in March, and suddenly it becomes very clear that this pandemic has now got a global grip, and the only way that we're going to deal with this is by lockdowns. And you start taking some preemptive steps. But at what point do you realize that actually this is something fundamentally different, something with which no executive working today has had to deal, certainly outside of parts of Asia, which have had other epidemics and things to deal with?
So 2 weeks before the lockdown, I realized that this was no ordinary wave of panic, that this was indeed a likely pandemic. And in fact, I had to cancel some of my holiday plans to come back to the office and navigate through the sort of pre-lockdown preparation. And so sort of 2 to 2.5 weeks prior to the lockdown, we had started preempting. Never in my wildest dreams did I imagine it would go on for as long as it did. I had fully expected a couple of months. I think, unfortunately, we had a bit of a confluence of events, you know, with the downgrade of the sovereign rating, with the enormous volatility in the oil prices, never in the history of trading have we seen oil futures going negative like we did at, in the Texas environment in the US at WTI. And so you couldn't have scripted a more perfect storm.
And unlike most businesses, you stay open and you keep working and you keep functioning. You send everybody home. Lots of people were sent home in different industries. I mean, pilots couldn't be sent home. They just went home and stayed at home. Those sorts of people couldn't work from home. And I suppose the digitization process of the JSE that ended the traditions of the market and the open outcry system and all of those wonderful things of years gone by that were started by Russell Loebscher and then enhanced by Nicky Newton-King. You must be pretty grateful to have had that little package handed to you as we can function from home in our pajamas if we need to.
Indeed. Can you imagine if were we to have an open outcry environment, how those burly traders with big personalities would have functioned in a socially distanced manner? So
even
indeed,
Wall Street got
I think
closed, though. Even Wall Street got closed down. Even that floor, the last big trading floor in the world, had to be closed. I mean, it truly shows the vulnerability of the system.
Indeed, and the Wall Street floor is largely a sort of augmentation to their already digital trading environment. So the trading still continued. I think from our perspective, we showed through the crisis that we were able to withstand the dynamics of the crisis, and we were very flexible, and tech is very much in our DNA. And so these investments that we've made over the years have really stood us in good stead. In March, our value traded was up over 60%, and our volumes were up over 100%. And yet our IT team did this in their day pajamas from home. And so this was a tremendous learning curve and tremendously enlightening in how we can indeed work in the future. I do think that it has an implication for the future trajectory and adoption of technology. And I think that we're going to see a much faster adoption rate of new ways of trading, perhaps digitized versions or even blockchain or Bitcoin expansion. And so we are prepared for that, and we are making ourselves a lot more flexible and agile.
Does the JSE even need a building anymore? I mean, if you look at the traditions of the JSE, in the early days of trading shares in dusty downtown Johannesburg with Charles Glass's brewery down the road in 1885, people traded shares between the chains in Hollard Street and then moved into a nice building with walls and then into Diagonal Street and then later into your current space in Maud Street, where you are now, where I think you occupy 10 or 12 floors of a very nice building in the middle of Sandton. Is it even necessary anymore?
Well, we've debated that, and we were quite agile in introducing a virtual AGM facility. And typically the building is now used, well, prior to COVID, was used for annual financial meetings, for market openings, all of which were happening digitally. And now with the advent of virtual AGMs, it's quite possible that the demand for that face-to-face environment will reduce. That said, I do think that there is something to be said for the community and social identity in physical interaction. And while we are likely to move to a maybe, let's say, 60% or 50% work from the office situation, I think it's unlikely that we will completely shift to a work from home environment. So yes, I think the building will be here to stay for a while, and we are likely to continue to have market openings in a face-to-face manner once the pandemic has passed.
Did the extent of the collapse of stock markets surprise you? I mean, we've seen chaotic things happen before, 9/11, 2008, but this was so quick, so fast, so vigorous, a pullback that we saw in March and then into April. It was quite a scary time.
Indeed, indeed. And I think that what surprised me more was the sharp pullback and the incredible V shape that the graph indicates. We were down in excess of 30%, and we had several single-day moves that would be notched up in the history books, whether that was up or down. So the tremendous volatility, and as I said earlier, the confluence of so many macro events affecting that volatility was extreme. What is intriguing is that, notwithstanding the fact that we yo-yoed down in this hyper-volatile March period to more than 35% down, we are now up for the first time on prior years on both our top 40 and our all shares. So we followed very much of a recovery curve aligned with the US, and I think that that's largely attributable to the fact that many of our stocks are, a large part of our stocks are tech-based, some of which derive their income from foreign sources, many of which do. Our resources have bounced back. Our resources in 2008 represented about 60% of market cap. That went down to 20%, and it's now up to a year ago, and it's now up to 40%. So I think what you're seeing is a shift in the relative importance or favor of certain sectors over others. And as a result, on the whole, we've recovered. When we compare ourselves to Europe, who are heavily exposed to the automobile, the airline, and also industrial sectors, they've taken a lot longer to recover. So while the volatility, I think, took everybody by surprise, what probably surprised most is the very rapid recovery, and the fact that the recovery is not necessarily reflective of the real economy position, both in South Africa and across the world.
I mean, there was that great Economist cover in the early days of the recovery, and it had the chasm between Wall Street and Main Street. And I mean, it's like Maud Street and South Africa's real economy, Jan Smuts Avenue or William Nicol, or pick your road. But it is this complete dislocation in markets. I mean, does it scare you when you look at economic fundamentals and how those have deteriorated around the world? The world economy is in recession. Yet as we speak, and this was recorded a couple of weeks ago, the S&P 500 hitting fresh highs, the Dow massively elevated, global markets partying like it's, I don't know, September 2008.
Bruce, I think the South African capital markets and financial markets at large are largely separated and insulated from the shocks of the real economy. And we've seen this over many years. And over the years, different features or factors have driven that. Right now, some of the key insulating factors which cushion investors who are now net positive on last year's gains are the fact that we have 108 dual listed companies. Those companies derive largely their income from offshore sources, and they are highly liquid and very attractive to foreign investors. In addition to that, we are dominated by stocks which are not necessarily a reflection of the underlying real economy. And as the economy generally evolves, you'll find that those large companies, like data companies, like tech companies, our Naspers and Prosus, for example, are not necessarily reflective of the underlying real economic activity. And so you're going to see a separation between capital markets and real markets on the ground.
Leila, I mean, you raised so many real pain points for South African investors. I mean, in this time of deep uncertainty, the credibility of South Africa's investment environment has deteriorated considerably. I mean, you look at returns over the last 5 years in Rand terms on the JSE versus S&P 500 dollar returns, and it's exponential. There is no comparison. How do you feel about the credibility of investment markets? People always talk about the credibility of the JSE, which makes it a bit more personal, but this is the credibility of the South African investing environment. And the fact is, if we took Naspers and Prosus out of the mix and a couple of the other large counters, British American Tobacco and Richemont, there's very little, frankly, of any real value delivery happening on SA Inc. companies on the JSE.
There certainly the top 40 are very deeply liquid, and there is a high degree of interest. And yes, Naspers and a couple of others do represent a high percentage of our volume and value traded. We are a concentrated market. We've always been a concentrated market. We have a history of large, very recognizable and well-regarded multinational brands, whether it's the old SAB or Anglo-American or BAT. And typically, what we have seen is an enormous interest in those large counters. And in the current environment where there is a structurally low growth outlook in the developed world, South Africa does offer a high potential yield. Our equity markets are undervalued relative to their forward outlook, and there is definitely an interest. South Africa is underweight in terms of the emerging market benchmarks generally. And there is definite interest in potentially expanding that exposure into the South African market. So yes, we do have a lumpy and largely concentrated market, but we also have highly credible and very well capitalized companies. We have a very well capitalized banking sector, which has taken an enormous knock over the last couple of months. We have very well-positioned commodity market. And as I mentioned earlier, that shift from 60% in 2008 down to 20%, back to 40%, indicates that South Africa as a commodities play in the market is well regarded. So notwithstanding the overhang of the financial markets and some of the other stocks, there is certainly an interest in the fundamentals, and South Africa is fundamentally on the cheat sheets. We're underpriced relative to our peers offshore, and we offer yield. And we also shouldn't forget that we offer deep liquidity in this market relative to most other emerging market countries. We are the 19th biggest stock exchange by market cap, which means that we punch way above our real economy weight.
However, we have a severe credibility problem as an investment destination. Our downgrade shows that, and the huge outflows that we've seen out of our bond markets and out of our equity markets by foreign investors and lots of domestic investors who frankly have given up on SA Inc. All of that value is fabulous, but it's what so many people have been calling value unit trusts for years as value traps. A lot of people feel that there isn't a future for South Africa, for its companies, and for investing on the JSE. Yet you are an individual who, in your own right, was in Australia. You'd left the country and you'd gone to work in Australia, and you came back. And I see Peter Wharton-Hood, ex of Standard Bank, and has been to Deutsche Bank, now is returning as the chief executive of Life Healthcare. And I just look at the complexity of the investment decisions and the life decisions that South Africans are taking, and often taking those investment decisions under huge personal stress and duress. We really need confidence in ourselves, in our country, in our economy, so that that confidence can then flow through to the JSE. And until that happens, I'm not sure we're going to realize those juicy valuations that you're talking about.
Bruce, indeed, confidence drives flows, and whether that is individual employee confidence, whether it's consumer confidence, or whether it's business confidence, all of those factors drive an interest in investing in the country, and we often are our own worst enemy. So we can't discount the enormous fiscal cliff, the low growth, the high unemployment, the structurally low growth and SOE crisis that we're facing into. But that notwithstanding, let's not underestimate what's going on in the world today. And I think we need only to look to the yields that our bonds are offering investors to understand that South Africa, on a relative basis, offers the best yield for the underlying risk in the emerging markets. So at any point in time, you can earn 7 to 9% yield on the 10-year govie. And compare that to an average of sort of 2 to 3% under normalized conditions of inflation. That's a real in your pocket gain of 4 to 5%. Those sorts of yields are few and far between, and it would surprise me if we were not on the radar of global investors. In fact, I've had a number of discussions with global investors who have indicated that they don't really consider South Africa in the China, Southeast Asia environment. But if they look at the BRICS countries, there is no question that South Africa appears very favorable. The comments are that Brazil is highly volatile. Russia is opaque and difficult to read, and particularly so pre the US election, because there is a sentimental connection in investment flows around the US election cycle. And so with the boom in PGMs last year and in resources generally this year, and with the ability of the banking sector, notwithstanding the big losses that they are announcing during the season, they have remained stable. These things all bode well, and we as South Africans need to be a little bit more balanced in how we see the world, and rather than revert to immediate catastrophe thinking, consider the positive factors and the many, many very strong and very impressive companies, multinational South African-born companies that we have on the exchange.
I mean, so, and you talk, I mean, I hear you, and what you say is absolutely true. South Africans permanently on the brink, looking into the abyss, waiting for disaster to strike and responding emotionally to every crisis that comes our way. And we've seen it time and time again. And we're going through another one of those periods now where people are genuinely concerned about the future. Regulation 28, talk to me about this and the role that the JSE can play in the relaxation of those controls on investments. Much of the frustration of the local asset management industry is that there's a smaller universe for them to invest in, and that causes all kinds of problems when it comes to asset prices. Billions of rands get poured in terms of retirement annuities and other investments every single year into a smaller and smaller market, which isn't giving the returns that asset managers would have liked. Can the JSE, and should the JSE, and is the JSE playing any role in broadening the scope of the investment universe for individuals?
So certainly we are leaning into that debate, and while there is a natural rand hedge in many of the top 40 stocks, given that more than 70% of the top 40 stocks derive their revenue ex-South Africa, that does expose or give opportunity to the local pension fund and asset manager community to shield themselves from the local dynamics of the macroeconomy. Notwithstanding that, we are looking into potential exchange control proposals or relaxation. So, for example, trade that is cleared, settled, and listed in rands, if it has a foreign underlying currently, it's classed as a foreign holding and eats into their foreign allowance. So there is we are struggling to see the reason why those sorts of stocks are not classified as local stocks. Internationals often struggle to trade on the exchange because collateral and their settlement has to be in rands. And so there's a genuine possibility that we could put forward a dollar-denominated settlement and margin placement, for example. So there are many, many nuances and small changes that could have a pretty large impact. But that said, companies like Naspers and BAT, etc., who derive their income from offshore sources and are also in next generation and growth node sectors, give the South African market a tremendous opportunity to increase and enhance their yields. In addition to the equity market, there's also a very favorable yield in the bond market right now and has been for the last 6 months. So there are opportunities to earn yield, and certainly we have some work to do, and it's an incredibly complex environment with potential unintended consequences to manage the removal of certain prudential constraints. One of the biggest benefits, of course, in removing exchange controls would be that we get the potential tick for being an OECD country, and that would, of course, open up inbound investment quite significantly. So this is not an insignificant and not an easy problem to resolve, and there are polar opposite views, both in government and in private sector, around what we should and shouldn't do, and I don't expect it's going to be an easy problem to unlock.
No, especially as with the talk of prescribed assets, and when South Africa's got massive revenue shortfalls this year, 300 billion rand, the economy is not going to recover to 2019 levels anytime soon, and so there are real fears that suddenly the long fingers of the state, which has not covered itself in glory, and I think I've been quite diplomatic here in terms of fiscal management in recent years, it wants to dip into pension pots to help it get out of its bottomless pits of the Escoms, the SAAs, the Denels, Pickham, state-owned enterprises, which have been calamitously operated for so long. And they want to come after our pension money in order to make the turnarounds. And trust us, government is saying, well, this time it's going to be different. This time we'll have some governance. This time we'll be better at it. Trust us, we're in charge. And South Africans have lost faith in that. And maybe that explains so much of the divestment that we're actually seeing.
Well, I think with Reg 28, there are a number of dynamics at play. And of course, prescribed assets would go contrary to free market forces. There are other ways to achieve a similar outcome via applying taxes to different asset classes, which would make a prescribed asset more favorable. I think the area that perhaps really needs to be opened up is the more speculative investment into small and medium enterprises, because I think that is the definite potential growth node in the South African market. And firstly, these SMEs need to recover, and then they need to grow their markets. And right now, the complexity with the dynamic in the flows onto the exchange is that largely the asset managers invest in the highly liquid stocks, which is the top 40. And that leaves the rest of the market, the sort of 300 odd main boards and Altex stocks in a relatively illiquid space. And even though there's a 10% allocation for more speculative stocks in the Reg 28 mandates, less than half of that is often taken up by that industry. So I do think that we do need to try and stimulate in this country an investor risk appetite to start investing in those lower liquid stocks. I do think that we also need to start encouraging retail participation and retail investment into the exchange. We have seen a pickup during the COVID crisis, particularly in the unit trust market, where there was 88 billion in the last quarter invested into collective scheme investments, which is essentially 50% of that is retail, and 68 of that 88 billion was new money. So I do think that the potential growth node could come from the retail investor. However, prescribed assets would definitely constrain and confine the free market concept.
No, absolutely. I couldn't agree with you more. And as somebody who has had faith, long lost faith in smaller companies on the JSE, because there's some spectacular businesses. There really are some great management teams, and they need the fillip of an underlying strong economy. And they also need investor confidence. And that's hard to find when you've been beaten down as often as investors in small companies have. Talk to me, if you can, a bit about global stimulus, about the cheap stimulus that has happened. 2008, 2009, Ben Bernanke floods markets with capital in order to get us out of the dwang of the financial crisis. This time around, we've seen the US Fed come to the party once again, the South African Reserve Bank becoming a buyer of last resort for government bonds and stepping into the breach there. Central banks are keeping the world afloat with cheap money. How does it play out? What is the consequence of what has happened in the last decade and a bit? Because we haven't seen negative consequence. We've simply seen asset prices grow and grow and grow with a couple of bursts of pullbacks, but overwhelmingly, nobody seems to think that, you know, crises can't be managed anymore. And it's quite an interesting place to be.
Well, I think one of the unfortunate complexities associated with this pumping of cheap money into the economy is that it widens the gap between the emerging and smaller markets and the developed worlds. And the reason for that is simply that America and many of the developed worlds' cost of repaying that debt is less than 1%. Our average cost on a 10-year basis is around 8%. So any fiscal stimulus that we raise will introduce an enormous debt overhang for the country and thereby constrain potential investment and thereby constrain growth. And so this is a genuine developed versus developing market concern. Equally so, there is an interesting conundrum that's being created, which the US, for example, recently changed their mandate, started investing into corporate debt. And so corporates had access to very cheap money, and that then fuels an indebted corporate environment. And when inflation starts to rise, the central bank is in a conundrum around whether to raise rates and potentially see corporates failing or default because they can't afford their debt burden, or whether they keep rates low and let inflation run. So this does create a genuine a problem for large and small countries alike. And the debt overhang creates a generational drag on the GDP growth of the future of each of those countries. And so I do think in 10 years from now, a dispassionate corporate historian might have a very different economic view on the stimulus. Insofar as how it plays out on the exchange, what we saw in 2008 is likely to play out again in this crisis, which is that cheap money stimulates the raising of private equity, and there is less of a public markets capital raising trend. And so we're seeing public markets contracting in line with the cycle. It will come back, but at the moment we're at the low point. So the JSE is responding to that by investigating potential to introduce private market placements. So that would be an exchange or an infrastructure that would enable private placement funds for SMEs and also potentially for infrastructure, both into South Africa and into Africa. So I think this whole dynamic of cheap money sloshing around the world does drive innovation, and it drives a different behavior in the investor profile. And unfortunately, it does have unintended consequences into the long term. But right now, politicians who are going to be elected between now and 4 years from now are focused on the here and now, and corporates are focused on keeping their head above water. And so what is different now to what we saw perhaps in the Great Depression is that there was a far more delayed response by government to inject fiscal stimulus into the economy. right now there was an almost immediate response, which was really largely learned off the back of the 2008 crisis.
Is inflation dead? I've spoken to a number of people who suggest that, I mean, if you've pumped so many trillions of dollars into the global economy since 2008, and we've done it several times since then, and inflation is like a bear in the middle of winter. You cannot awaken it. I just worry that one day it does wake up and it's peckish and it comes out roaring, but it hasn't happened yet. And some people argue that inflation, in fact, is dead.
Well, I don't think that inflation will flatline permanently. The question is how long it will take to pick up. It would be naive to imagine that this is the end of the world and growth will disappear from our general macroeconomy across the world. And I think a lot of large countries have enormous debt that they have an incentive to inflate away. And so those fiscal stimulus will be directed towards job creation and towards industries that will increase the activity in the real economy and thereby increase debt. I think the key problem, so I don't think inflation is dead. I think that it is likely to flatline for a bit longer than most other economies, most other cycles have indicated. And I do think that there is some pretty bullish economists out there predicting a much sharper and faster recovery rate. I think in the emerging markets, it's likely to take longer to evolve than in the developed world, because the shift from joblessness to new net job creation is a lot sharper and faster. As we've seen in China, post their COVID episode in sort of Q4 last year, they had a very rapid return. I fail to see the likelihood that emerging market economies have the firepower to instill growth and therefore translating into inflation. I think that the high level of indebtedness that both individuals and corporates have built up pre-COVID and now during COVID will create a genuine concern for central banks in how they manage potential inflationary spikes that we're likely to see down the road. Let's not forget, during history, if we go back to our history lessons, many of the major crises have been followed by, unfortunately, by large wars, as we saw in after the Great Depression. The World War was a genuine inflation creator, and so it's hopeful that we avoid such an outcome, but it's not outside of the realm of possibility. I think equally so, trade wars and other fundamental dislocations could create a lot of volatility, which could alter the course of the recovery.
Leila Fourie, thank you very much indeed for giving us a perspective today on the current state of markets, your perspective and not to what you expect may happen in the future, but the future isn't what it used to be. It's deeply uncertain, it is unsettling, but you'll get a good perspective today, having seen Leila Fourie, Chief Executive of JSE Limited, the company that runs the market, and I think the JSE is in safe hands. Leila Fourie, thank you. Etienne, back to you.
Thank you, Bruce.
Thank you, Bruce, and thank you, Leila, for updating us. We certainly appreciate your insights into these volatile and complex markets and the difficulty of making financial decisions in these circumstances. In fact, it again underscores the value of objective financial advice for the retail investor. So if you're not yet a PSG client, I urge you to make contact with one of our PSG advisors. It will certainly add a layer of comfort and insight to your financial decision making. So in closing, thank you for spending the time with us today. We trust you found it insightful as usual, and we hope to see you again at one of our webinars in the future. Until then, please remember to stay safe. Thank you.